All right, folks, so let's talk about what happened this morning. It's important to pay attention to because obviously the last couple days the market was red. Today we're sort of oscillating at like essentially zero with the indices, although some individual stocks are doing just totally fine. AMC announced a stock split, and we've got a little bit of a deeper inversion of the yield curve between the 5 and the 10, and the 10 and the 2 have also inverted. So it's like, oh no, what is this potentially going to signal? Well, I want to show you what it could potentially signal. But first, just a quick mention, this video is brought to you by Extra. Go to mettkevin.com/extra to build your credit without a credit card. You can link this to an existing bank account and boom, check out the magic of Extra. It's pretty neat what they do. Now, take a look at this though. So you go over here. I tweeted this yesterday. The 10-2 yield curve just inverted. I wrote this last night. This happened in July, August of 2019, and you know what happened over the next 12 months thereafter? The S&P 500 returned 18.25%, the NASDAQ returned 60%, and Tesla stock returned 869%. One of the things that I noticed about the yield curve is that historically the yield curve inverts when there's a lot of fear or uncertainty that, oh no, something bad's going to happen, and generally it's signaled a recession, especially the 10-2. Now there's a debate. Does the yield curve have to stay inverted for a long period of time? If the COVID pandemic didn't happen, would we have uninverted the yield curve and not had a recession? I mean, think about it. Would we have had a recession without the pandemic happening, right? And so it's like, did the yield curve in 2019 just happen to invert because of short-term bond market fluctuations? And is it maybe not the best judge of recession? Nobody really knows. It has been very consistent that at some point in the next 18 to 24 months, we might hit a recession. But hey, you look at this yield curve inversion from the COVID pandemic, it's like, oh, that's not that bad. But you know what else is not that bad is that jobs report that we got this morning. We know the unemployment rate fell to about 3.6%. Black unemployment fell to 6.2%. Some of the greatest levels that we've seen in a while. Take a look at this one down here. The number of permanent job losers declined to 1.4 million in March. And that's a little different from February of 2020 when the number of permanent job losers were at 1.3 million. That's great. But another thing that's also great is that almost every category gained jobs with the exception of warehousing and transportation, roughly flat, down about 1,000. But what was really great is the month-over-month payrolls increased about 13 cents. Now, in January, I was really, really sad because we had the sign of a wage price spiral starting. The report came in showing us an 8.6% rate of wage growth month over month and then annualized, right? That's terrible because that's more than the rate of inflation was at that point, which signals a wage price spiral. This is really bad, and the University of Michigan was telling us the same thing. Now that ended up getting revised down to 6.6. So they changed it. And then it's like, oh my gosh, how manipulated is this data, right? But anyway, the next month of February it was 0, and now it's 4.8. These are great. All three of these numbers here are fine. No wage price spiral. Like, one of my main fears that could have led us to a stronger, like Paul Volcker style recession is gone. Not only do I not think we're going to get Paul Volckered by the Federal Reserve, but I do think that we are in a situation where our employment market is not overly hot. It's hot. We got like 10 million jobs available, right? But it's not at a point where I think we need to get Paul Volckered, which if we had a wage price spiral, the Fed would do everything in their power to make sure the wage price spiral does not become entrenched. That would be very, very, very bad. So where does that put us now? Well, I mean, if you think about it, obviously, with a strong jobs report, markets are going to probably price in a little bit of a higher chance of that 50 basis point hike. So you're going to see a little bit of fluctuations on this. I think this is why when we got a good jobs report this morning at 5:30 a.m., I was watching this. I'm like, oh, of course, NASDAQ like instantly drops 0.5%. Why? Well, because people are worried about that potential 50 basis point hike. And I look at that even and I'm like, dude, this is not Paul Volcker. Like, I was worried in January that we were going to get some kind of Paul Volcker, which would be like, hey, we're just going to raise rates 2% now because inflation's so out of control. They're not doing that. Even if they do a 50 BP hike, which now is getting priced in even more. Right now we look at about a 76% market chance of a 50 basis point hike. So the market's kind of like, yeah, we're pretty confident 50 BP is going to happen. And even if it happens, who cares? And so this is where I also look at where we are market-wise. We don't have any massive new fears to bring us down to like that triple bounce that we had on the QQQ. Here, we'll go ahead and pull up the QQQ exactly, and we'll look at it together right here. Look, we don't really have any new scary news. The reports that are coming in now are either benign or not worse. Like, sure, things haven't gotten like substantially better, but if anything, oil prices, commodity prices are starting to settle a little bit. It looks like Russia's focusing mostly just on the Donbass, which we expected. We're moving away from this idea of an all-out war. We're moving away from this idea of nuclear weapons. Russia's not cutting off gas supplies to Europe, right? Things are settling down. Like, cooler heads are starting to prevail. Now, but why do we have a little bit of red here? Well, because quite frankly, we shouldn't be in these upper bounds until really war ends, until some of the madness goes away. We should not be trading above or in the range of the top third of the S&P 500 or the NASDAQ, which we kind of still are. Actually, no, we just dropped below it on the SPY. We were yesterday. So not a big deal to me. Now, I was planning on shorting the NASDAQ when we got into this level because I think we would have had a pretty large drop. This right here, falling off of 61.8 down to 50%, not super excited. If anything, yesterday I bought the dip a little bit because I'm keeping a lot of cash on the side for the expectation that we're going to have some form of maybe a little drop and then a rebound, but not a lot. I mean, I'm 85% in this market. I have more shares now than I did before in January, so I'm really happy about that. And you are seeing some individual stocks run pretty decently. And in my opinion, one of the things that you can do in this market is really consider exposing yourself to some upside protection. Like if you got some $90 calls, for example, on Trade Desk, those are killing it today. If you got some inexpensive out-of-the-money call options on ARK Invest or Matterport, some stocks that have been depressed, hey, those could be inexpensive ways to either potentially lose all of the money you put on that upside hedge or make a decent amount of money. But that way you don't have to go all in if you don't want to. So it gives you an option of, literally gives you an option, right? Just be careful, you know, obviously options can lose value very quickly. You've got theta decay. You don't want to hold these things too darn long. But those are things to keep in mind. Those are things to consider. Not seeing wage price spiral, not worried about the economy. Really, I'm super bullish. So I don't want to be like mega bull here and say, hey, go reckless. Like me personally, just to be transparent, I've got about $430,000 in short-term call options, like anywhere between 4 to 8 weeks. I think that bond rotation we had yesterday and the day before is pretty much over. Wouldn't be surprised if we end up the day green here and then end up having a pretty green period of time with a brief pause for CPI data, which we expect to be bad anyway, coming out, you know, in a couple weeks. But then pretty much chillaxing until the Fed actually has their meeting at the beginning of May. So we got quite a bit of time to wait for that 50 basis point hike, and really, even if we get it, who freaking cares? Anyway, those are my thoughts. Thanks so much for watching. Go check out Extra via the link down below, and folks, we'll see you in the next one. Thanks. Bye.